What if I told you the worst market crashes in history have created the greatest wealth transfers ever recorded? What if the moments when everyone is panicking, selling, and swearing they'll never invest again are actually the exact moments that millionaires are quietly being made? And here's the uncomfortable truth most people don't want to hear. Market crashes don't destroy wealth, they transfer it from the impatient to the disciplined. So the real question isn't how do you survive a crash? It's how do you position yourself to win massively when it happens? Because if you get this wrong, you panic, sell low, and lock in losses. But if you get this right, you could be buying assets at prices people will wish they had years from now. So in this video, we're going deep, not surface level advice, but a full strategy on how to think during crashes, what to buy, when to buy, what mistakes destroy investors, and how to turn fear into long-term profit. And by the end, you'll never look at a market crash the same way again. If you're serious about building wealth, not just chasing hype, hit the like button, subscribe, and stay till the end. Because the last strategy is what separates average investors from the ones who quietly build life-changing portfolios. Let's start with the biggest misconception of all. Most people think market crashes are rare. They're not. They're normal. They're part of the system. And once you understand that, everything changes. Because crashes are not accidents. They are features of financial markets. Think about it. Markets go up because of optimism, growth, innovation, and expansion, but they reset because of fear, excess, overvaluation, and correction. And that reset, that's the opportunity. But here's the problem. When crashes happen, they don't feel like opportunities. They feel like the end of the world. News headlines get louder. Social media gets more negative. People around you start saying things like, "Get out before it gets worse." This time is different. The system is broken. And if you don't have a plan, you will follow the crowd. And the crowd almost always gets it wrong. So before we even talk about investing strategies, we need to fix your mindset. Because your mindset during a crash determines everything. Let me say that again. Your behavior during a crash matters more than your intelligence. You don't need to be a genius to make money in the market, but you do need emotional control because crashes test one thing above all: patience. Let's reframe how you see a market crash. Imagine your favorite store suddenly announces everything is 40% off. Do you panic? No. You get excited. You look for what you can buy. You take advantage of the discount. Now imagine the stock market, which represents ownership in real businesses, suddenly drops 30%, 40%, even 50%. What do people do? They panic. They sell. They run away. That's the contradiction. People love discounts in stores, but fear discounts in markets. And that's exactly why wealth gets transferred. Now, let's get practical. How do you actually invest during a market crash? Let's break it down step by step. First, and this is critical, you need cash or liquidity because opportunities mean nothing if you can't act on them. One of the biggest mistakes investors make is being fully invested at all times. That sounds good in theory, always in the market. But in reality, it removes your ability to take advantage of downturns. Smart investors always keep some dry powder, not because they're trying to time the market perfectly, but because they want flexibility. During a crash, cash becomes power, because when prices drop, your buying power increases. Second, you don't try to time the exact bottom. This is where most people fail. They wait and wait and wait, trying to catch the perfect moment. But here's the truth. No one consistently times the bottom. No one. Not professionals, not hedge funds, not billionaires. The bottom is only obvious in hindsight. So instead of trying to be perfect, you aim to be consistent. This is where a powerful strategy comes in. Dollar cost averaging. Instead of investing all your money at once, you spread your investments over time. For example, if you have $1,000, instead of investing everything today, you invest $100 every week or every month. Why? Because during a crash, prices are volatile. They go down, then up, then down again. By spreading your investments, you reduce the risk of buying at the wrong time. And over time, you average into lower prices. Third, focus on quality, not hype. This is where crashes separate real investors from gamblers. During bull markets, everything goes up. Bad companies, hype stocks, risky assets, they all look like winners. But during crashes, weak companies get exposed. They collapse harder, and some never recover. So instead of chasing what's trending, you focus on strong, proven businesses. Ask yourself, does this company make real money? Does it have strong cash flow? Does it have a competitive advantage? Will it still be relevant in 5 to 10 years? Because a crash is not just about buying cheap. It's about buying value. There's a difference. Something can be cheap and still be a bad investment, but a strong company at a discounted price, that's where opportunity lives. Fourth, control your emotions. This might be the hardest part, because during a crash, everything around you is designed to make you emotional. The news amplifies fear. People panic publicly, markets move fast, and your portfolio goes down. That last one hurts. Seeing red numbers triggers something psychological. It feels like loss, even if you haven't sold anything, and that feeling pushes people to make bad decisions. So you need a rule. You don't make emotional decisions with long-term investments. You stick to your plan. You remind yourself, I'm investing for the future, not reacting to the present. Fifth, zoom out. Always zoom out. When markets crash, it feels like everything is falling apart. But when you zoom out, you see a pattern. Every major crash in history has eventually been followed by recovery. And not just recovery, growth. Markets don't move in straight lines. They move in cycles, up, down, sideways, then up again. So instead of focusing on short-term drops, you focus on long-term trends, because wealth in the market is built over years, not days. Now let's talk about something most people ignore, your risk tolerance, because not everyone should invest the same way during a crash. If you're investing money you'll need soon, a crash is dangerous because markets might not recover in time. But if you're investing for the long term, 5, 10, 20 years, a crash is less of a threat and more of an opportunity. So you need clarity. How long can your money stay invested? Can you handle volatility? Will you panic if prices drop further? Because the worst strategy is one you can't stick to. Now let's get deeper, because there are advanced strategies that experienced investors use during crashes, and these can make a huge difference. One strategy is buying in phases. Instead of investing randomly, you plan your entries. For example, invest 25% when the market drops 10%, another 25% when it drops 20%, another 25% at 30%, and the final 25% if it drops further. This way, you're systematically taking advantage of deeper discounts, and you remove emotion from the process. Another strategy is rebalancing your portfolio. During a crash, different assets fall at different rates. Stocks might drop heavily, while bonds or other assets remain more stable. Rebalancing means adjusting your portfolio back to your target allocation. So if stocks fall and become a smaller portion of your portfolio, you buy more stocks to restore balance. This forces you to buy low automatically. Now let's talk about a powerful truth. Crashes create asymmetric opportunities. This means the upside potential becomes much greater than the downside risk. When prices are high, your potential gain is limited. But when prices are low, your potential upside increases. This is why investors who buy during crashes often see the biggest returns over time. But there's something you need to avoid at all costs: panic selling, because this is where most wealth is destroyed. People buy when prices are high, then sell when prices drop. They do the opposite of what works. And once they sell, they often miss the recovery because they wait for certainty before getting back in. But by then, prices have already gone up. So here's a rule you should remember. The biggest gains often happen when fear is at its peak, not when things feel safe, not when headlines are positive, but when uncertainty is high. Now imagine this scenario. The market crashes 30%. Everyone is panicking. But instead of reacting emotionally, you stay calm. You follow your plan. You invest consistently. Fast forward 5 years, the market recovers and grows beyond previous highs. Your investments, they've multiplied, not because you were lucky, but because you were disciplined. This is how wealth is built: quietly, patiently, against the crowd. Let's talk about one final idea that can change how you invest forever. Time in the market beats timing the market, because the longer you stay invested, the more you benefit from compounding. And compounding is powerful. It turns small, consistent investments into significant wealth over time. But it only works if you stay invested, and crashes are the biggest test of that. So here's your takeaway. Market crashes are not your enemy. They are your opportunity, but only if you're prepared, only if you stay disciplined, only if you think long term. If you've made it this far, you're already ahead of most people, because most people don't study this. They react. They follow noise. They miss opportunities. So here's your call to action. If you want to become the kind of investor who benefits from chaos instead of fearing it, start building your strategy now, not when the crash happens, because by then, it's too late to think clearly. And if this changed how you see investing, hit the like button, subscribe, and share this with someone who needs to hear it, because the next crash is not a matter of if, it's a matter of when. And when it comes, you'll either panic or you'll be ready.